Here is the number that trips people up. Just $400 in net self-employment earnings can require you to file Schedule C and Schedule SE, even if you already have a full-time W-2 job, according to IRS guidance. That is not a typo. $400, not $4,000. Get this wrong, and you can owe back taxes on income you did not even think counted. Stick with me, and I will show you exactly how to report it right. I read the fine print so you don't have to. The core number here is 15.3%. That is the self-employment tax rate applied to 92.35% of your net earnings, according to IRS-based guidance for 2025 and 2026. That rate covers Social Security and Medicare, and it hits before any income tax is calculated. Understanding that one figure changes how you think about every dollar of side income. When you earn wages, your employer withholds taxes automatically, but self-employed income works completely differently. You report your net business income on Schedule C, then you calculate self-employment tax on Schedule SE once net earnings reach $400 or more, according to IRS instructions. Nobody is withholding anything for you, so the entire bill lands on you at filing time. That surprise is exactly where people fall behind. Here is what that looks like in real dollars. A freelancer earning $50,000 in net profit can owe roughly $7,065 in self-employment tax before income tax even enters the picture, using the IRS and H&R block calculation method of taxing 92.35% of net earnings. That is money most people never set aside. If getting hit with a surprise bill like that would hurt, the next steps are how you avoid it. Your first move is to check whether you even hit the filing trigger. And you do this using the free IRS Self-Employed Individuals Tax Center. Gather all your business income and your deductible expenses, subtract to find your net earnings, and then confirm whether Schedule C and Schedule SE are required. The benchmark is simple. Are you at or above $400 in net self-employment income? Good looks like knowing this before filing season ends, never waiting for a 1099 to decide for you. Your second move is to reconcile every dollar you actually earned against your own records, using IRS earned income and self-employment guidance. Compare your bank deposits, app payments, invoices, and cash receipts. Then add income from any 1099 NEC, 1099 MISC, and 1099K forms you received. Crucially, you must also include non-1099 income and the value of barter. Good looks like your reported gross receipts matching your actual business activity, not just the forms that happen to show up. Let me make this concrete with a real example. Take Maya, a marketing consultant earning $82,000 from her W-2 job, plus about $18,000 in net freelance income. At 15.3%, on 92.35% of earnings, her $18,000 implies roughly $2,536 of self-employment tax before income tax, using the IRS and H&R block method. She thought it was too small to matter. It was not. Your third move is to actually estimate your self-employment tax using the Schedule SE instructions on irs.gov. Take your net profit from Schedule C, multiply it by 92.35%, then apply the 15.3% rate from the Schedule SE rules. Good looks like being able to explain your expected self-employment tax bill before you file, instead of discovering it after your return is prepared. If this walkthrough is useful, subscribe, or the next breakdown is already coming. Before I get to the most counterintuitive part of this, here is why reporting is not just about taxes today. When your net earnings hit $400 or more, they are supposed to be counted through Schedule SE. And that record feeds the wage history Social Security uses to calculate your future benefits, according to SSA guidance. Skip the reporting now, and you can quietly shrink the benefits you collect later. It is not just a tax problem. It is a retirement problem. Now, the most counterintuitive piece, the myth that quietly costs people the most. Many freelancers believe that if no 1099 arrives, there is nothing to report. That is flat wrong. The IRS requires all business income to be reported, including cash, checks, card payments, and barter income, whether or not any tax form was ever issued. The missing form does not erase the obligation. It just erases your paper trail, and the IRS still expects the full amount. Let me put the myth and the reality side by side so it sticks. On the left, the myth. If you did not get a 1099, the income is invisible and you can skip it. On the right, the reality. All business income is reportable whether or not a form was issued, including cash, checks, card payments, and barter, according to IRS guidance. Underreporting today can mean back taxes on the full amount later, plus damage to your benefit history. Let me recap the whole system fast. First, check your $400 filing trigger using the IRS Self-Employed Individuals Tax Center. Second, reconcile every income source against your records, form or not. Third, estimate your self-employment tax at 15.3% on 92.35% of net earnings. And never forget, reporting builds your Social Security record, and a missing 1099 never excuses you from reporting. Getting your self-employment income reported correctly is the difference between keeping your money and repaying thousands later. Next, I'm covering the quarterly estimated tax payments that stop freelancers from getting hit with underpayment penalties at filing time. If you want to catch that, subscribe so you don't miss it. This has been general information only, not personal tax advice. Check the IRS instructions and your own circumstances before you file.